Let's talk about severe convective storms, or SCS. For a long time, the insurance industry saw this as a source of predictable, manageable losses. But that has completely changed. Now it's a dominant, capital-threatening challenge. So how on earth do you price and manage a risk that seems to be rewriting the record books every single year? Well, let's break it down.
First, let's start with a number, just to set the stage. $94 billion. Let that sink in for a second. That was the combined global economic damage from severe storms in 2023 alone. This isn't just another number on a spreadsheet. It is a massive, industry-shaking figure that, frankly, demands our full attention.
And this quote from a recent Aon report really frames the problem perfectly. We've got to stop thinking about these massive storm seasons as random, one-off events. This is the new certainty we're all operating in, and that means we need a fundamental shift in how we approach this kind of risk.
Now have a look at this. This is what really drives the point home for me. We're talking over $58 billion in insured losses from SCS in the US alone. That absolutely dwarfs a major named event like Hurricane Idalia. It just goes to show you that SCS isn't just a problem. In many years, it is the dominant driver of catastrophic losses, period.
Which of course brings us to the big question, right? When you see a trend like this, can you really afford to rely only on your own company's historical claims data to get ready for what's coming next? Is the past really a good enough guide for the future of this particular peril? Let's dig into that.
So this brings us to what I call the claims-only dilemma. Every actuary, every underwriter out there knows your own claims data is gold. It is your ground truth. But for a risk like severe convective storms, relying on it alone, well, it's a trap. It's absolutely necessary, but it is dangerously insufficient. On the one hand, of course, claims data gives you the undeniable reality of what happened. You see your own settlement behaviors, all the quirky policy language that comes into play, the real-world operational costs. It is fantastic for understanding your day-to-day attritional losses. But, and this is a huge but, it's almost completely blind when it comes to pricing for those extreme, capital-busting events that can make or break your year. So why does it struggle so much? Well, first off, SCS events cluster. They come in these massive outbreaks, creating correlations your historical data has never seen before. A hailstorm in Texas and a tornado in Oklahoma might hit in the same week, and suddenly your losses are stacking up in ways you didn't predict. Second, even the biggest carriers rarely have enough clean, long-term data for every single region and segment. Third, the world is changing under our feet, right? Exposure is growing, building codes are different, the climate itself is shifting. And finally, and this is probably the most important point, you have what's called sparse tails. All that means is the truly catastrophic, portfolio-breaking years are so rare in your own history that you just don't have enough data points to reliably estimate how bad they can get or how often they might happen. So the real takeaway is this. Your claims data is absolutely essential, but its best use is to anchor, to validate, and to challenge the output of a catastrophe model, not to try and replace it. Which brings us to the modern toolkit for understanding this kind of complex risk, catastrophe models. So let's quickly pull back the curtain and demystify what's actually going on inside that so-called black box.
It really boils down to four pretty logical steps. First, you've got event generation. The model simulates tens of thousands of synthetic years of storm activity. Think of it as creating countless possible realities. Second, the hazard module turns those events into physical intensity, like what was the hail size or the wind speed at this exact latitude and longitude. Third, the vulnerability module takes that hazard and estimates the physical damage it would cause to different kinds of buildings. And finally, the financial module applies all your specific policy terms, your deductibles, your limits, your reinsurance, to calculate the final dollar loss for every single event.
And here's the magic of it all. The model doesn't just give you one answer. It gives you a full distribution of thousands upon thousands of possible annual outcomes. It's creating this vast synthetic history that lets you see the risks that haven't happened to you yet but absolutely could. Okay, so now that we have this incredibly rich data set from the model, we have to look beyond just simple averages. To really get a handle on this risk, we need to understand the statistics that describe the entire picture, especially those painful extremes out in the tail. We always start with the metric everyone knows, the average annual loss, or AAL. It's exactly what it sounds like, the mean loss across all those thousands of simulated years. This is the essential building block for your baseline pricing and your technical rates. It's where the entire conversation has to begin.
And you knew there was a but coming. AAL tells you nothing about the volatility. It doesn't tell you anything about the severity of those rare capital-draining years. To get that, we have to move our focus from the average to the tail of the distribution.
So let's talk about VaR and TVaR. Value at risk, or VaR, tells you the loss you'll exceed at a specific probability. So a 1 in 100 year VaR of $50 million means there's a 1% chance in any given year of losing at least $50 million. But it doesn't tell you if that loss is going to be $51 million or $500 million. That's where TVaR, or tail value at risk, comes in. TVaR answers a much better question. In all the years that were worse than that $50 million mark, what was the average loss? Your TVaR might be $80 million, which tells you, okay, when a bad year happens, this is how bad it really gets on average.
And this chart just illustrates that difference perfectly. Your AAL is your baseline, down here. The VaR is significantly higher. That's the cliff edge, the start of the tail. But look at the TVaR. It's higher still, because it's averaging all of those truly terrible outcomes beyond the VaR. It is a much more complete and frankly conservative measure of your extreme risk.
So, we have the models, we have the metrics. Theory is great, but how do we actually connect this to a practical playbook for making smarter business decisions?
This right here is where the rubber meets the road. Each of these metrics has a specific job to do. You use AAL for your baseline pricing. That's the expected everyday cost of doing business. But for setting your capital, for figuring out how much you need to hold, you look to TVaR to understand what a truly bad year costs. For structuring your reinsurance program, you're analyzing the entire exceedance probability curve to see exactly where you're most vulnerable and where you should buy protection. And, this is critical, for steering your portfolio and deciding which new risks to write, you have to look at the marginal impact a new policy has on your tail risk. Does it make your worst-case scenario even worse, or does it actually add some diversification? Each metric answers a totally different but vital business question.
And the payoff for getting this right, it's immense. We are talking about true rate adequacy, where your price covers both the average day and the extreme event. We're talking about portfolios that are genuinely diversified, based on their tail risk, not just their zip code. It means buying reinsurance that is robust and capital efficient because you're protecting your specific vulnerabilities. And it gives you a clear, confident, and coherent story to tell your board, your regulators, and the rating agencies.
And listen, this isn't just a nice idea. It's rapidly becoming the standard of excellence. This quote from the Lloyd's Maturity Framework makes it crystal clear. This isn't just a job for the actuaries and the modelers anymore. Senior leadership and the board have a direct responsibility to understand this stuff, to challenge it, and to use it to make key strategic decisions. It's a fundamental part of good governance.
Let me be very clear about something. The ultimate goal here is not to blindly trust a model. It's not model idolatry. It's about using the model's output to sharpen our judgment, to ask better questions, and to dramatically improve the quality of every single decision we make, from an individual risk all the way up to the entire portfolio strategy.
And so that really just leaves us with one final question to think about. In a world where this kind of climate risk is a certainty, are you building a business that's prepared for the gentle averages of the past, or are you building one that is truly resilient enough to withstand the violent extremes of the future?